If I could get your attention, I'd like to welcome everyone. I'm Mick Sybil with UNICO Midlands, and on behalf of UNICO Midlands and our host today, Blue Cross Blue Shield of Nebraska, we'd like to welcome you in person to this seminar. And just so you're aware of it, we're also broadcasting this via a webinar to some of our clients and associates who could not be here today. So if you in the audience have a question, the mics will pick up what you're asking the speakers, but we'd ask you to speak up just a bit if you tend to be on the shy side so that they can pick that up, and the speakers will try to repeat the question for our webinar guests. We also are recording it so that it will be available for playback if you happen to have an associate or someone in your office that would like to hear it later. We'll give you a connection for a playback. So what we're going to do today is talk a little bit about UNICO Midlands to start with introductions, and then we're going to turn it over to the experts from Blue Cross Blue Shield to talk about the reporting requirements, which we realize is the main reason you're here. But just in terms of the commercial part first, on behalf of the UNICO Midlands team, I'd like to ask the producers and the employee benefits team from UNICO Midlands to please stand up and recognize you as a group. So as you can see, we've got quite a group of people here. And for those of you that maybe didn't get the news or aren't up to speed on the news, UNICO and Midlands had a merger last fall. We officially became one group in October, albeit we'd worked together for a couple of years prior to that. So you'll see some of our branding as UNICO Midlands. And for those of you that aren't familiar with UNICO Group is a employee benefits and commercial insurance broker. We're about 110 people. We do business in 38 states now. So we've got a large set of resources behind us, not only for employee benefits, but for commercial insurance, workers' comp insurance, et cetera. And we do work with a lot of different carriers. Our favorite carrier is obviously Blue Cross Blue Shield. And we want to thank them and Tracy Larson for everything she's done to set this up. She got us the food and the room, so we obviously owe Tracy a great big thank you. She has some team members here today that will be introduced in just a minute. But two more things I wanted to point out. One, if you need a restroom, out this door to your right are the restrooms. Please just utilize them as necessary. The meeting will conclude at 1 o'clock, so hopefully we won't cut into your afternoon schedules too much. And number two, we wanted to talk just a little bit about UNICO Midlands and something that we think is pretty exciting. 6 months from now, we're going to be moving into one of the NEBCO-owned buildings downtown, so we'll become a neighbor of Blue Cross Blue Shield. Some of you might be familiar that Midlands has a building in South Lincoln, UNICO has a building on O Street. Both groups have grown so large, we decided we're going to have to co-locate. So there's going to be some new office space announcement about 6 months from now, and we'll be getting that out to all of our clients, obviously, as the time draws nearer. Theoretically, it'll be February 1st. Now, that might mean 2 months either side of that, depending upon what things happen, as some of you that have ever been through a relocation know. But hopefully that news will be coming out, and we'll be able to share that when the time comes. Today, we're excited to have experts that can talk about some of these crazy reporting requirements that the Affordable Care Act has forced on all of us. As clients responsible for an employee group, as brokers and people that work with clients, just as ordinary citizens, we're all faced with kind of complicated and ever-increasing challenges with these things. Today's not meant to give you every answer. Today's meant to be in a continuation of the conversation. Some questions you've asked us individually hopefully will be answered. You're more than welcome to ask questions of the speakers as we proceed through this. Blue Cross was gracious enough to provide the handout, which will be most of the slide information and some of the commentary. So that is obviously yours to make notes, take home to your colleagues, etc. But hopefully we'll get through at least some of your questions and help add to some of your knowledge base that we all need to do our jobs day to day. If any of you would like a little more food or drink, obviously help yourself. Don't wait for us to invite you a second time. It's kind of like a family gathering. You have to just kind of take it on your own and do it when you need to. We may have a few more clients who were running late for meetings this morning, and so we'll welcome them as the time comes. But without further ado, I would like Tracy to come up, and she's going to introduce the rest of the Blue Cross. And again, Tracy, thank you for hosting today.
Well, thank you. I wish I could say I made all of this, but I have a kitchen facility here. Otherwise, I would have. Thank you for saying that. But, actually, I have such a wonderful group of people behind me in the coffee show that there's no way that I can do my job without them. And so I have two really, our speakers today are just awesome. Karen Arch, who's our legal counsel. He's done this work pretty much since healthcare started. And so he has our backbone here at Blue Cross, a huge resource. And so much we have it. You guys have had the first group to hear about this new tax law. So he's done most of it. He didn't make the rules. And then today we have Dave Peterberg as well, Director of Finance. He did the first time that we had the registry have his account, and I'll have to be a backup on the accounting side. But with that, again, we appreciate business this year, and then the previous years, we kind of had a challenging year, and so we so appreciate you guys having the opportunity to be your carrier. So again, thank you so much, and again, I have a huge for people. So I don't know, Blue Cross, do you want to go ahead and say, what your role is here, and maybe decide the client you work with, and maybe you guys kind of put some names and faces with everything you know.
My name is Carol Herman, and I'm in account management, and I work with the CUDA 99 client.
And Joyce Kresnica, and I work with account service rep, and I work with the Blue Price, Blue Freedom group size, and I work right along with Carol.
I'm Pat Hefner. I work on the small group to the 99 sales side.
And if you don't mind, I'm going to jump right in here because these two, Bob Bagel is my other teammate. He does all of our paperwork, eligibility. If Bob wasn't here, there would be no me because Bob is just a huge back. I mean, he'll take vacation, he still answers my calls. I don't know why. I would, but he's amazing. He's in the Omaha office and I'm in the Lincoln, so that makes it our team. And then I'm really excited to say I have a brand new manager, Sarah Kodani, and she's a couple months. She's amazing. So she's coming from that being said, I think, and Kim, can't forget Kim. Kim is my webinar attorney. She's the technical piece, so thank you for setting up. And again, if you're on the call, I think we've got 2 people on the call. It's my understanding, Kim, correct me if I'm wrong, you're going to be muted for now. If you have any questions, you can do it in the chat box.
Yeah, that's correct, and I've let them know also.
Great. Well, thank you, Tracy and Mick. Thanks for having us today to talk about the exciting world of the Affordable Care Act. It just keeps getting better as each day goes on. So that's why we're here today, to talk about employer shared responsibility and the tax reporting requirements that are associated with that mandate. So that's what we want to talk about. And then I'll spend just a few moments talking about the Cadillac tax, something else that's getting a lot of play in the media right now as we approach 2018 when this goes into effect. And then even more imminent is the King v. Burwell Supreme Court case. And this has huge implications depending on what the Supreme Court does with the premium subsidies that are available in the online marketplaces. So that's where we're going today. As was mentioned, if you do have any questions as we go along, feel free to jump in. This does get pretty I don't know how to say it. It's some heavy stuff and it's technical, but we'll do our best to keep it conversational. Now, before we jump into those tax reporting requirements and then the bulk of our presentation, I did want to just lay out some groundwork here. So some terms and definitions that we should all be aware of as we talk about tax reporting. Now, minimum value. When we talk about minimum value, what we're talking about is the health plan designed to pay at least 60% of the total cost of the coverage under the plan. So 60% of the cost borne by the plan itself, while the 40%, would be paid for by the individual, by the employee. So that's minimum value, equal to about a 60% actuarial value. Then there's affordability, and this is something that's been discussed as far as employer shared responsibility, but affordability is really just where the employee's required contribution is less than 9.5%, and this has kind of been increased a little bit to 9.56% if you want to get real technical, but it cannot exceed that threshold, and it's based by rule on household income. Now, along with that, however, there was a safe harbor in place, and I know a lot of employers have taken advantage of it, but affordability can also be based, if you want to take advantage of this safe harbor, on employee wages. So looking at W-2, Box 1, employee wages, to decide whether the plan that you're offering is affordable for that employee. Now, something really to note here is that the affordability under the safe harbor is only based on the self-only lowest cost coverage that's being offered to the employee. So regardless if they have family coverage, affordability would be based on that lowest cost option. So that's affordability. And then we look at minimum essential coverage, not to be confused with minimum value, but minimum essential coverage, I would say, is pretty much any major medical coverage. So if you have an individual policy, if you have an employer-sponsored coverage, any enrollments in a government program like Medicare, Medicaid, CHIP, TRICARE, any of those would constitute minimum essential coverage under the law. All of Blue Cross's plans, aside from our short-term limited duration plans, our temp care policies, would be minimum essential coverage. And so not a lot you have to worry about there, but that's a term to be aware of as well. Now, the other one I don't have a slide for, there's a definition for what is a qualifying offer under these tax reporting requirements. Well, a qualifying offer is one that, first of all, meets minimum value, so it's meeting that 60% actuarial value. It's also affordable to the employee. It's minimum essential coverage, and on top of that, it's being offered to any spouses and their dependents. So that would be a qualifying offer under the rules that we're going to talk about today. All right, so those are the terms and definitions we should all be aware of. Now turning to just a brief overview of the employer mandates in general. And this may be a refresher for many of you, but I wanted to, again, set some groundwork here as we talk about the reporting associated with the mandate. So beginning this year in 2015, if you're an employer and you have 100 or more full-time equivalent employees, so you've looked back in the year prior and decided, you know what, I do exceed that 100 FTE threshold, I'm going to be subject to the employer mandates, most likely upon my plan year. So any employer, applicable large employer, is going to have to comply with the employer mandates and offer health insurance coverage to any full-time employee. Now, full-time employee, having a totally different meaning, one who averages 30 or more hours a week or 130 hours a month. So that's a full-time employee under the employer shared responsibility requirement. Now, in deciding whether you are an applicable large employer, you're going to be looking back at the number of hours worked by employees on working days during the preceding calendar year. So if any particular month, you know, I have 100 or more full-time equivalent employees, I'm going to be calculating that on a monthly basis and then averaging that over the 12-month period during that preceding calendar year. In 2016, so that was 2015, 100 plus have to required to comply with the employer mandates. In 2016, this threshold drops down to 50 or more full-time equivalent employees. So it's based, again, on hours worked by employees on business days during the preceding calendar year. Now, the coverage that's being offered to employees, again, it has to be affordable, so it cannot exceed that 9.5% of employee wages, and it has to meet minimum value. If any of these elements are not met, there could be some penalties involved. So if you're an employer and you're not actually offering any coverage at all to your full-time employees, those who are averaging 30 or more hours a week, you could be stuck with a $2,000 penalty times every full-time worker on your payroll. Now, the trigger for that penalty is if any full-time employee goes to the health insurance marketplace to purchase subsidized coverage. All right, so that's penalty number one. Penalty number two is if you are offering coverage, you're an employer, you're trying to comply, doing your best, but for some reason or another that the coverage is not affordable or it doesn't meet minimum value, you could also be stuck with a penalty that's equal to $3,000 times every employee, every full-time employee that goes to the exchange to purchase subsidized coverage. Now, a little bit of a clarification there between the two penalties. Penalty number one is multiplied against your entire full-time employee population. So if you have 100 full-time employees and only one of those goes to the exchange, 100 times $2,000 is going to be your penalty. Where the other penalty for not being affordable, that would be based only on each individual who goes to the exchange to purchase subsidized coverage. So if one person goes, you're just stuck with $3,000 for that individual who left to purchase subsidized coverage. Okay, and I continue to get questions on this, so I just wanted to touch on it briefly. But in determining whether we as an employer, whether we're an applicable large employer subject to the employer mandates, we have to take into consideration our part-time employees. So to do that, you're going to look at total hours worked in a month by all of your part-time employees, add those up, and divide by 120. And that's going to get you to the number of full-time equivalent employees that you have. So an example here, let's say a restaurant has 20 part-time employees. They're all working 24 hours a week or 96 hours a month. These 20 part-time employees, that's going to break down to be counted as 16 full-time employees, so full-time equivalent employees. It's kind of on a pro rata basis there. But you take 20 part-time employees times the 96 hours worked in a month, that's 1,920, divided by 120 hours, gets you to your 16 full-time equivalent employees. So I would then take that number, I would add that to my total number of full-time employees in a month to decide whether I exceeded the 100 or more full-time equivalent threshold. All right, and then finally, just on the employer mandates, as far as our overview here, we said that the requirements for the employer mandate is to offer coverage to all of your full-time employees and their dependents. A little bit of a caveat here, a dependent does not include stepchildren or foster children. It also doesn't include spouses. So a lot of questions we get is, can I carve out spouses? Yes, you may continue to carve out spouses, at least under the employer mandate. Now, you do have to take steps toward covering dependents, which would be mostly biological children, but as far as stepchildren, foster children, or spouses, not required to offer to those individuals. Something else to note here is the effective date. So generally, I would say any non-calendar plans that aren't beginning January 1 may comply at their plan year. You want to go back and look at the rules, but generally, if you do have a non-calendar plan year that doesn't start on January 1, this employer mandate would be effective at your plan year. Now, if you do happen to owe any penalties, the good news is that at least in year 1, you can subtract out 80 full-time employees from those penalties, so a much lesser penalty to start out with, but it does ratchet up from there. And finally, if you are in that 50 to 99 full-time equivalent category, so you're banking on a 1-year delay where this won't go into effect until 2016, you are going to have to certify on the tax forms that we're going to talk about here in a moment. I'm going to have to certify that you're taking advantage of that 1-year delay. Okay, so just because you don't have to comply in year 1 in 2015 with the employer mandate, you still have to certify that you're taking advantage of that delay. Okay, and I would like to just kind of point out this resource here. I found it very helpful. This IRS Q&A really gets into the weeds. So if you need some extra guidance and want to look back, that link is pretty helpful, and I encourage you to take a look. All right, so without further ado, let's jump into the actual tax reporting. And I'm a lawyer. I'm not a tax guy. So we do have David Cederberg here, who is a...
You're real quiet.
Yeah, right. We'll direct any hard questions to him, but he is our Director of Financial Operations and is an expert on a lot of this stuff. So when we talk about tax reporting, we're talking about requirements under the Affordable Care Act, Section 6055 and Section 6056. And the whole purpose behind this is really to help the IRS have information and to help employers and individuals comply with the employer shared responsibility mandates and the individual mandates. So we saw final regulations back in March of last year, and now just recently we saw finalized tax forms, so we can talk about it now. But just to break it down, Section 6055 on the ACA really has to do with the reporting requirements for health insurers, as well as a small sliver of self-funded employers in that 1 to 50 employee range. So a lot of you, I would say, probably won't have to worry about Section 6055 unless you are or have clients or are a self-funded employer in that 1 to 50 range there. Now, Section 6056, something probably more important that most will want to pay attention to, this is the reporting requirements for employers who are subject to that employer mandate, meaning you have 50 or more full-time equivalent employees. So 56 is where we want to really pay attention there. But just to give you an overview of Section 6055 and what a lot of insured members will be receiving, Section 6055 is required for all health insurers and self-insured employers in that 1 to 50 employee range. So we as a carrier, Blue Cross and Blue Shield, we're going to have to provide tax form 1095Bs to all of our insured members, both on the group side as well as on the off-exchange individual market. So 1095Bs will be sent out to all of our insured members. We have to furnish these forms by January 31st of 2016. So looking back at tax year 2015, our effective date for getting these 1095Bs out, January 31st of 16. Along with that, we're going to have to take this information from the 1095B and we're going to have to file that with the IRS and do so by March 31st since we're filing electronically. So 1095Bs sent out to all insured members and file that back with the IRS. Just from an awareness perspective, you know, it's a great question. Like, what's the purpose behind this 1095B? Why are we having to comply with just one more provision in the ACA? Well, this is really, I would say, kind of self-serving for the IRS, but it's meant to help them determine two things. Number one, it's going to help them determine whether any individual mandate penalties are owed by certain individuals. And number two, it's going to help the IRS determine whether individuals receive subsidies throughout the year that basically they shouldn't have received. Because as we know, you know, if you're an employer and you're taking steps to comply and you're offering coverage that's affordable, it meets minimum value, that employee and his or her dependents should not have access to subsidized coverage on the exchange. So this reporting is really supposed to help kind of weed those out, and there could be some reconciliation that's required on the back end, meaning people may actually owe money back to the federal government if for some reason they received a subsidy that wasn't appropriate.
Can I jump in here too?
Yes, please, Dave.
Since we got a good broker group here together, something to also kind of keep in your mind, Blue Cross will be sending out these 1095Bs, so your clients and people, you know, employees of the group will be receiving them from Blue Cross, so you may get questions on them. We'll try to put some communications out there on our website and to you guys to help explain it, you know, to them also. The other thing to be aware of is Blue Cross will be from July 1st through probably September 30th. We're going to be going through all the data that we have on our systems and trying to solidify SSNs, TIN numbers, and all of that to make sure they're as accurate as we possibly can make it. So we may be going out with some mailings to some members, and so you may, we'll try to keep you guys in the loop as we go through this process, just so you know that your clients may be getting notified from us saying, hey, we don't have an SSN. We have actually our data, we've done a preliminary thing on it. We're sitting really, really good, but we may be doing some more reach outs. So just kind of an awareness for you guys.
Great, thanks, Dave. Now, as far as what's on the 1095B and the content within the form itself, it's basic information starting out here. So the employee's name, date of birth, social security number, some of the employer information, the insurer information, and then we get into the name, date of birth, and social security number for every family member who's under the plan. And finally, the most important piece, I would say, the months of coverage of the previous year that each family member had under the plan. This is really to point out any coverage gaps that would subject those individuals to potentially an individual mandate penalty. All right, so that's Section 6055. Now we turn to Section 6056. And again, this is for applicable large employers who are employing 50 or more full-time equivalent employees. They are going to have to both furnish 1095C forms to every full-time employee and also take this information and actually give 1095Cs for each full-time employee, file those with the IRS. Now, there is an authoritative transmittal form that will be used, and that's a 1094C that will be submitted back to the IRS in your filing. So three things there. Number one, furnish the 1095Cs to all full-time employees, file those with the IRS, and use the transmittal form to submit information to the government as well. The purpose behind this, a couple of things. Again, determine if there are any penalties involved from an employer mandate perspective, and two, determine whether employees received affordable coverage that does meet that minimum value requirement that would make them, therefore, ineligible for subsidized coverage under the exchange. Now, something to note here, I don't know if we have any association or multi-employer plans. When we talk about who is responsible for reporting under Section 6056, it's really down to the EIN number. So each employer is going to be responsible for filing for their employees. Now, like Section 6055, the effective dates are the same here, but we're looking at 2016 effective date. So furnishing these 1095Cs to the full-time employees by December 31st, and then filing these back and getting your transmittal form filed with the IRS by March 31st if you're filing electronically. If you are filing by paper and you're under 250 filings, you can do so, and that would be due February 28th to the IRS. Now, you do have a 1095C tax form in front of you folded up there, and I think this might be helpful just to reference as we do walk through the form. So I'll let you pull that out. But on the 1095C form itself, the employer is going to have to fill in the boxes on that form using specific codes that are identified in the instructions. Now, a code is going to be used for each month to indicate whether the employer actually offered minimum essential coverage that is meeting minimum value and is affordable to the employee. And the code is also going to indicate whether the coverage was offered to any spouse or dependents. And you can see them there, and I don't know, Dave, if you have any comments on that. It's codes 1A, I believe, down through 1I.
On the back of the form are the codes, 1A through 1I. 1I would be actually one of the transition relief safe harbors. And then it kind of goes through 1A through 1I, kind of goes through different scenarios that you may have within each of your companies or your groups. I think the majority of people will probably be filing a code 1A. We can talk more about that maybe as we get into the Q&A session of it, because I'm not sure of the makeup of all the different companies.
Sure.
So.
Now, if the other thing is if the health coverage that's being offered is not a qualifying offer, so one of our terms, meaning it's either not meeting minimum value or it's not affordable, and it's not being offered to spouse or dependents, so it's not a qualifying offer, you're going to have to actually do some calculating here and include the employee share of the lowest cost self-only coverage on the form. So that's only if it's not deemed to be a qualifying offer. Now, the code specified in the instructions will also be used to indicate the months for which the employee was not a full-time employee and the months in which he or she was enrolled in coverage. Now, finally, and Dave mentioned it, code 1I, I believe it is, if the employer did rely on any safe harbors, they'll need to indicate this on the form. And just some examples of some popular safe harbors. One of them, again, for affordability, basing this on employee W-2 wages as opposed to household income, that's considered a safe harbor, and so you're going to have to make note of that on the tax form. The other safe harbors available are the non-calendar year plan relief safe harbor. So if you're going to comply as of your plan year, which is not January 1, you're going to have to note that on the form as well. And then finally, if you're in that 50 to 99 full-time equivalent employee range, you're going to have to note that you are, in fact, taking advantage of that one-year delay, the transitional relief that's available for you. So that'll be noted on the tax form as well. Part 3 on the 1095-C is only for self-funded employers. So if you're fully insured, don't have to worry about Part 3. But here you're going to have to provide the name and the Social Security number for each individual that's covered. Okay, so let's recap just on the data elements that we should be looking for and starting to track as we look toward 2016. But the 1095-C data elements, number one, we're going to have just general employee contact information, including the Social Security number. We're going to have to know the months in which the employee was offered coverage. Did it meet minimum value, and was it affordable? If we're not making a qualifying offer, so it's not affordable or it doesn't meet minimum value, it's not being offered to spouses or dependents, it's not qualifying, we are going to have to calculate out the employee share of the lowest cost self-only coverage for that month. Note any relevant safe harbors on the form. And then finally, if you are a self-funded employer, Part 3 is going to require the name of all covered individuals, including their Social Security number and the months of coverage for the employee and the family members. So those are the basic data elements that will need to be included in the 1095-C. And finally, as I mentioned a little bit earlier, if you have less than 250 filings, all this slide says is you can file by paper. So anything more than 250, the IRS requires you to file electronically. And I don't know, Dave, how do we file electronically? Is there a website for that, or?
There's a software that you can file electronically through the IRS.
File electronically through software provided?
It's very similar to what you do for your W-2 filing. As we go through it, I mean, there's different, I know payroll companies are just getting into this, and maybe payroll companies don't have everything they need yet. I think they will by the end of this year. But there's other vendors out there that we use to do all our filings, basically, that we can talk through. And then we can also, it's been years, but we have filed our own, 1099s and stuff. Once you just have to register with the IRS, and then there is a little step-through process that you go to upload all your data into their system. But I was talking to Ryan Swinton earlier. I know ADP is out there as a payroll vendor that's kind of getting into this. Blue Cross and Blue Shield of Nebraska uses a tax reporting company called Convey, and we've used Convey for years for our 1099 reporting. We're also going to utilize them for our 1095B reporting, and as a company, we have to file 1095Cs also, so we'll be utilizing them for our C reporting also. But there is a way you can do it without actually going through a software company if you want to, and I haven't done that for years, but I can do some research on it, and if anybody's interested in that, maybe remind myself how we used to do that.
It's like riding a bike, right, Dave?
Yeah.
The other thing is that you can, as we are doing as Blue Cross, you are able to outsource this to a third party for your filing requirements, but this doesn't transfer any liability. So you, the employer, are responsible for the filing and furnishing these forms to your full-time employees. I did want to mention, maybe just from an awareness perspective, but for any individual policy holders, also going to receive like I said, on the off-exchange market, a 1095B from us, from their insurance carrier. But if they have coverage through the exchange, the federal government's going to send and has sent this year a 1095A. Again, this is just to establish compliance with the individual mandates and help reconcile any premium tax credit information that may or may not have been appropriate along the way. This is also distributed by January 31st and was done so. I know there was some media coverage about how it was all screwed up, and hopefully they fixed all the 1095As by then, but that'll be happening on an annual basis from here on out. Before I jump into the Cadillac tax, I'd like to open it up to any questions that we might have. We could also do Q&A at the end if you'd prefer. Are we going to answer those today from the webinar? Or?
Yeah, I've got a couple that have come in, so
Okay.
we're going to do it after.
We'll do it after, sure.
Yeah, I think the main thing to remember on the 1095C is it's a fully insured group. You're really only worrying about Part 1 and 2. It's the self-insured groups that will end up having to do what we call a combined 1095C filing, which then includes your dependent information. So as long as you're fully insured, you won't have to be reporting, and Cameron, this is where I want my lawyer to make sure I'm not saying anything wrong. You won't have to file the dependent information on Part 1 and 2 of the 1095C because they'll be receiving a 1095B from us, Blue Cross and Blue Shield of Nebraska, giving all their dependents that are covered and what months they're covered. So it'll kind of work in tandem on the fully insured side.
And well, I think that's right, Dave's comment. I would note that we are not tax advisors. This is not legal advice today, so I have to throw that in. This is how we understand it, and there are some smart people who may disagree, and they do from a lot of our calls that we've been on, but this is the world as we know it, just to help you, guide you along the way. Okay, with that, yes, in the back.
One quick question. Will Blue Cross provide a certification to their fully insured and self-insured group that their plan meets that minimum value requirement?
Will Blue Cross provide certification that plans meet minimum value?
Yes. So
Yes.
for all of our plans, and again, keep me on track if I start going off track. All of our plans meet the minimum value and meet the 60%. So from that perspective, you're covered. I don't know that we've ever put anything out there.
Yeah, the summary of benefits and coverage, there is a box, I believe, at the end of it for checking whether you meet minimum value, and they all should be checked as, if you're fully insured, they should be checked as minimum value. Ryan.
Okay. Well, you say all the plans, but you have a number of employers out there that are self-insured. Have you checked those employers? Are they all?
Well, self-insured opens up more questions.
Certify those as well.
So we will not certify self-insured employers for minimum value. We have done a preliminary analysis, and I think only one fell outside of the minimum value. But that is up to the plan sponsor to certify that, and we actually leave that blank in providing the summary of benefits and coverage, the SBC, to those plan sponsors, just to fill in themselves.
Just for everybody.
That's a great clarification. Thank you, Ryan. Appreciate that. Any other questions before we march on here? All right, if not, we'll jump into the Cadillac tax. And this is only starting to get some attention because we did see some recent guidance. Our bulletin number 1 of, I think, many to come, but it provided a little bit more clarification on what employers should be planning for as they look to the costs of their health insurance plan for 2018. So beginning in tax years after December 31st of 2017, so 2018, there's going to be a 40% non-deductible excise tax that's assessed on the monthly cost of coverage for the health plans that exceed a certain annual limit. Those thresholds, as we know them now, and I think they'll be adjusted here in the future, those thresholds are set at $10,200 for self-only coverage and then $27,500 for family coverage. It is adjusted by a health cost adjustment percentage in 2018, and I think we did just a brief analysis to begin with. It was a couple $100 increase maybe on the threshold.
Yep.
Yeah, so
it won't be substantial.
the thresholds will go up based on this health adjustment, but only by, we think, a couple $100. So more to come on that. Nothing substantial. So the 40% excise tax, it's on the dollar amount that exceeds that cap, and it does apply to coverage under the group health plan. But any accepted benefits, so anything like a standalone dental or a vision plan, would not be counted in the aggregate cost of the health plan. So that would all be carved out. Basically, I think they define it as, we're counting the cost of any group health plan provided to the employer that's excluded from the employee's gross income under the rules. So this other stuff, this fringe benefit stuff, would be carved out. Still a question on employee assistance programs, whether those will be included in the cost of the health plan, but more to come on that. Now, the tax is determined by the employer, but it may not be actually paid for or paid by the employer. So the health insurance issuer is going to be paying it for insured coverage. Now, if there is an HSA contribution involved, the employer will be paying the excise tax if applicable. And then finally, in that last bullet down there, the person that administers the plan for other coverage, like self-funded coverage, what the guidance says right now is that the person that administers the plan is going to be paying the coverage. Well, what does that mean? Is it the carrier? Is it the third-party administrator? Or is it the employer? And so I think we need more clarification, at least for self-funded employers, who's going to be responsible for paying that excise tax if it's applicable. Now, the tax itself applies to the overall aggregate cost of the plan provided to an employee. Now, when we say the total cost, we're really looking at the applicable COBRA premium. So the full premium, that COBRA premium for the fully insured plans, the COBRA rate, and I'll talk about that in a second, for self-insured plans. But it will, I should note, it will include contributions to FSAs, HSAs, and HRAs. Those will all be included in that aggregate cost of the plan. So, for example, just a real simple one here, if that total cost exceeds the annual limit by $1,500, you're looking at an excise tax 40% of $600. Now, this is calculated separately for self-only coverage versus anything other than self-only coverage. So, two buckets there as we look at calculating the cost of the excise tax. A couple of different methods as we look at COBRA applicable premiums, especially as we look to self-funded plans, self-insured plans. A couple of ways the guidance allows you to calculate this COBRA premium. Number one being the actuarial basis method, where the cost is equal to a reasonable estimate of provided coverage for those similarly situated beneficiaries, and that's determined on an actuarial basis. Or number two, looking at the past cost method, where we're determining the COBRA premium based on the cost of the plan for those that same class of individuals during the preceding 12-month determination period. So, I don't know, Dave, do you have anything to add on that? That's beyond me, really, but I'm not an actuary and don't pretend to be one.
Well, right now, I mean, we're still digesting a lot of this at Blue Cross on the Cadillac tax. So we're kind of running both scenarios and just trying to see how it impacts. There's going to be more to come on this. As Cameron said, this goes into effect January 1st, 2018. On some of the tax calls that I have been participating on lately, there's been a lot of talk about the Cadillac tax. There's still some uncertainty on some of the provisions that sit inside the Cadillac tax that as a company and as Blue Cross and Blue Shield Association, we're trying to get clarification on. So, I mean, I'm sure as this year goes on and 18 draws closer, we're going to have probably more information to share with you on it.
Thanks, Dave. Yes, hopefully we will, and I think there's a lot of regulatory updates to come, and I'll mention that here. One final note, for any high-risk professions, should any of your clients serve within these professions, there are the higher limits on an annual basis, those being $11,850 for self-only coverage and $30,950 for anything other than self-only coverage, so family coverage. That's for people like first responders and any law enforcement, fire professionals. So something to note there. And as Dave said, this is really we're in the beginning stages right now of regulatory guidance. We saw one bulletin that was released. It actually asked for a lot of comments back from the public. We are expecting another bulletin here shortly. Beyond that, we're going to have an official notice for proposed rulemaking, which will then have a 60 to 90-day comment period, followed by a final rule. So it could be years down the road before we have final guidance, hopefully in time to comply by 2018. But we'll see how it goes. So that's where we're headed. Yes, John.
If this were to take effect in 2015, how many of your plans would be subject to this? Do you have a feel for where?
As far as we haven't really done a look at all of the plans that we have and what may or may not be subject to this. We're in the process, actually, I have a meeting when I get back today where we're kind of going through the process of dumping all our rate tables and starting to run these calculations to see. I don't think we're going to have any popping out into this, but we're just in that initial process of dumping all of that information and saying, here are the ones, and obviously if we find plans that we're selling and you guys are impacted, we're going to let you know that may be subject to the Cadillac tax. So we're in the process of actually gathering that information now. Like I said, I was just on a tax call last week where we were talking about the Cadillac tax, and there's still some unclarity, especially as it relates to HSAs and FSAs, on how that's going to impact this, because everything in a lot of the guidance we've seen talks about annual, but then all of a sudden there's some little clauses in there that says about calculating it monthly. We're trying to get, so in an HSA, if you calculate it in January, you're going to get a different answer than if you calculate it over a full 12-month period. So we're still trying to sort out all of the rules on the Cadillac tax, and I think within the next 2 weeks I will have something worked up as far as the plans that Blue Cross and Blue Shield of Nebraska has, and are there any plans out there where we look like we might have an issue with hitting that for our customers. So thank you. You bet. That's a good question though, because that's exactly what we're trying to figure out right now. My gut tells me we're okay, but we haven't pulled the data yet. Okay. And again, no tax advice, right, Cameron?
This is a tax advice.
You're supposed to disclaim.
Oh, right. Any other questions on Cadillac tax? Yes.
This will apply to all size from 2 to any size?
Yeah, the question was, will it apply to all sizes? The answer is yes. Just all depends on that total cost of the plan.
But group, not individual.
Yeah, group. Question. Any others? If not, I will leave you with just an overview here of the Supreme Court case, King v. Burwell. And like last year, and was it last year? I don't even know anymore. There's been a number of Supreme Court cases in the ACA. It's all a blur at this point. Challenging the constitutionality of the individual mandates, which then had an effect on Medicaid expansion, and so we've seen a lot. But this case, King v. Burwell, could really have a huge impact and disrupt the Affordable Care Act as we know it today. And what it's really based on, and that issue in the case, is a clause in the statute itself, and the clause says, an exchange shall be a governmental agency or nonprofit entity that is established by a state. Established by a state being that one clause that they're really focusing on. So the plaintiffs are reading this very literally. They're saying, you know what? 36 states chose to do federal exchanges. So they punted back to the feds to run the exchange for them. Is that really established by the state? Only 14 of those really did truly establish an exchange. Nebraska, for instance, forget it. We wanted a federal exchange. We chose not to take control and establish that. So they're reading it in black and white and saying, you know, the statute says established by a state. So the government, on the other hand, the defendants, they're saying, you know, that's ridiculous. Why would Congress write a statute like that to limit those in federal exchanges from receiving subsidies and taking full advantage of the federal tax credits? So they presented their arguments to the court. It's up for the 9 justices to decide. But if the Supreme Court actually rules in favor of the plaintiffs, we could see all advanced premium tax credits, you know, those subsidies thrown out. You know, no longer would anybody who's receiving a subsidy in a federal exchange have access to premium subsidies. Kind of a scary thought. Should the Supreme Court go down that route? But it is very possible. And our experts right now within our Blue Cross Association are saying, you know, 5-4 decision could go either way. But they're saying, based on the arguments that were heard, we could very well see the subsidies being struck down. As far as when that would happen, hopefully enough time to react and for states to react. But it is, I think, a pretty big possibility.
Cameron?
Yes, Brian.
Some of the implications on that, it goes a little bit further than just the subsidies, too. For employers, I think the big implication here is if the government strikes down the subsidies, that means that, you know, for an employer to be penalized, an employee must have gone to the exchange and received a subsidy. So if an employee cannot receive a subsidy, you as the employer can therefore not be penalized. So it's bigger than just the subsidy itself.
Absolutely, yeah, it'll have huge downstream impacts. Thanks, Ryan. For employers, you know, on the employer mandates, there's no trigger. There's maybe no penalties involved. We think about providers, the hospitals, and the impact it'll have on them, with patients being able to pay for their bills. I mean, they're already struggling with that. So huge implications, something to definitely keep an eye on. We should have a decision. As I mentioned, the justices did meet. They have conferenced, like they do, a few days after the oral arguments. And so they've made a decision. It's very secretive, and we should hear that decision by the end of June. So it's coming up shortly here. And with that, I would like to open it up to any questions that you might have, and those listening on the webinar to ask questions as well. Yeah.
I'm just curious, on the safe harbor for the W-2 income, they're using box 1, which would already have pre-tax health insurance coming out of it. So it's almost like they're using a lower number to calculate, you know, because you've got 401k coming out of that, you have all your cafeteria sign coming out of that, so they're using a lower number as that safe harbor. Is there any discussion on, I mean, Medicare wage seems like that would be probably the more.
Yeah.
Go
So I'm just going to say the question, you know, was like, well, why is the government using under the safe harbor for affordability that box 1 for W-2 wages? Because it's a lot lower after you take out all of those extra benefits. But did you have a?
No, and I think again, I'm going back a year or two now on some of the calls that I've sat in over the years. That was a point of contention on some of the calls that I sat in on. I think the government's perspective on that was without setting it at the household income, they felt for whatever reason that box represented a better number to run against the poverty level. There was a lot of discussion though on exactly what you commented on, because people went back and forth on why are you taking that after my pre-tax, but you know, it's I don't have a great answer for you, but I can tell you it was discussed.
And it's pretty solid, like all the discussion has been had.
Yep.
This is what they're
Oh yeah, it's a done deal. And if you ask consumer advocates, I mean, there's a lot of backlash from them as well, especially when you base it on the lowest cost self-only coverage as opposed to the family coverage. You know, is that fair? Really, it really could be at the end of the day unaffordable for the family. Question in the back, yes.
You may have mentioned it already, and I missed it. On the 6055, the 1094s, the Bs, and the 1095B, I guess it is. Will that information also go from you to the employer? Will you give them a copy of what gets sent?
On the 1095Bs, no, not right now. I mean, it was just going to be, it's between the carrier of the health plan and the individual that's holding the coverage. You know, I don't know that we have any plans on doing that. You know, I think that's a good question. Like I said, those Bs and those Cs, as it relates to fully insured groups, kind of work hand in hand. But we're taking data, you know, that's getting supplied to us through Blues and Roll and through our other systems, so everything should be a match. But I think it's worth noting, and again, I'll reiterate that, you know, Blue Cross will be reaching out to members, not all members, but some members, as far as if we feel we're going to run SSNs through some validations. We can't get a hold of the TIN matching that the government has because they aren't letting us do that. But we do have validations. We can run SSNs just to make sure they're valid SSNs. And we will do solicitations on anything that is an invalid SSN. So you may hear from some of your groups on that.
Thanks, Dave. Now, if the question I got yesterday too was like, you know, we're running our data matching to make sure the SSNs align, and what if employers do find out from their employees that something's incorrect on their 1095Bs that are being provided by us?
Then, if that's a great question. So when we issue 1095Bs, all our fully insured members will have their 1095Bs by January 31st. When they get those 1095Bs, and if they realize something is wrong, they need to go ahead and notify their group or the group leader or notify Blue Cross and Blue Shield of Nebraska directly, because we have until March 31st to correct any incorrect numbers that we may have filed. So, I mean, that's another thing to be aware of, too. So, if they notice something, they can reach out to us, but chances are it could be we could have done something on our side to, I don't know, key it in wrong or somehow, so we don't have exactly what maybe was submitted from the group. As we find those, I mean, we want to address them, so I guess I'd encourage the members or you guys, through the groups, through the members, to go ahead and, if they realize something is incorrect, to notify the group and Blue Cross as quickly as possible, because we would want to get those correct.
Thanks. Yep. Other questions? Should we turn to the webinar, folks?
Yes, there's one question. Are companies taking advantage of the 1-year delay while Blue Cross and Blue Shield still send out their 1095B for 2015?
So companies that are taking advantage of the 1-year delay on the employer mandates and reporting that back on the 1095C, is Blue Cross going to be still offering the 1095Bs in year 1? And the answer is yes. We most certainly will, and we are required to do so.
And for filing the forms to full-time employees, do you do forms for the part-time employees who you count as full-time? Which of those employees do you decide on or all?
So I think the question is, for the 1095C employer reporting, do they provide those to everybody, including part-timers, or just the full-time? It's my understanding that it's just the full-time employees that you'd be providing the forms to.
And then are we going to send out the handouts, or can they be printed off? So I would think we should be able to send.
Will we be sending out the handouts and having those available to those on the webinar? And the answer is yes. Nick is saying from the back. And that's all the questions. Any others before we? Yes, ma'am.
So when employees get these 1095Bs, they really won't have to do anything with that unless they went to the exchange or but then they wouldn't. What do they do with them?
Well, once they.
Good question.
Okay.
Jump in.
Once they receive the 1095B, so when they're filing their taxes for 2016, whether they're using TurboTax or whether they're going to one of their tax accounts to do it, there will be, like on line 61 or 60, I can't think of which lines it's on now. Next year they'll actually be asking for a 1095 form to validate that you have coverage. So that's why, just like for W-2s, that's why Blue Cross, as an insurance carrier, has to have those mailed by January 31st. So each one of those people, when they go in and do their taxes, and their accounting person asks them, where you cover things, so yes, here's my 1095.
So it's actually going to be attached to the return if it's filed manually and somehow.
Yeah. So because the 1095Bs will be, obviously everybody's going to receive one. We'll also be sending an electronic file to the IRS, so they'll have it on file too. I don't know if you're filing electronically. I'm not for sure whether they'll have to be physically attached to the form or not, to be honest with you. So I'm sure they will let us know that in 2016.
Great. Others? Yes.
If you change health carriers mid-year, you might have multiple.
Great point. You might get multiple 1095Bs, because if you had one coverage with Aetna for a while, which we hope that never happens, and then switched over to Blue Cross, which is a good thing. Yes, then you were.
Yeah, in that case, it's okay. Right.
So many of our clients are looking for assistance on this reporting. You mentioned a company called Convey.
Yeah.
Could we get contact information for that? Yeah. Question number one. And two, are you aware of others that offer?
Yeah. So I'm sorry, I didn't mean to cut you off. The main two big tax reporting entities in the United States are Convey and Thomson Reuters. Blue Cross and Blue Shield of Nebraska uses Convey. I had a meeting I meet with Convey weekly right now, since there's so much going on. And what our partner at Convey is going to do is print up a bunch of pamphlets and information. So when we go, and I'm sure we will put them on the broker website too. So as we go and we have these meetings with brokers, we can start handing that out, and it'll give some good information on, what Convey can do. I was talking to them about the packages that they have. They have different packages, so they have some affordable packages for smaller companies that, just need to file their 1095 fees that'll probably be reasonably priced. And I'm trying to get all of that information, in pamphlets so we can get it out to you guys.
What was the second one, Convey?
And Thomson Reuters.
And Convey is going to have like a 20% discount for people who are with us, right?
And Dave has paid a commission for all of this, yeah.
I'm not a tax advisor.
Well, that's just something to think about.
I know.
Talk to Convey about because,
I'm sure they will price it. Since they're with us, I'm sure we will get as good as prices we possibly can for everybody. Good.
Yes.
Back to that Cadillac tax, and I know this is still a ways off, but by that time, groups up through 99 will be age rated, possibly. The different rating. How do you figure that? What will that value be then, or how will you figure that value?
Well,
And
excellent question.
Is that another?
That's a great question because you know what we just had again. We had a conversation on that last week. That's why we are trying to get all of our rate tables pulled out of our system so we can start run scenario testing. Because to your point, you might hit that, might go over the limit. And that's what we're going to try to do. We're going to try to do some testing to see is there any of our non-age sex rated plans that even come close to hitting those amounts. And then we're going to run some scenarios on the data that we have in our system to say, do we got anybody in there on an age sex rated basis that might start blowing those out?
Okay.
Great questions. Thank you. Appreciate your time. We'll turn it back to Mick.
Help me thank Cameron and David for their time.
Well, I don't know, I had a couple things. One, did you find this helpful? And the second thing is, as with myself included, when that tax season comes, what you start saving in the mail for your accountant is, I'm thinking, okay, somebody's going to misplace the 1095, now what? Is there something that we can do? I mean, I'm sure we'll probably send emails to give you a heads up, hey, these forms are being mailed, but is there something else that you have suggestions to help your employees remember to hang on to the 1095 and show it, or anything else you think is different?
Either send a copy to the employer of all of them, or will it be available if they're, say, enrolled in or Nebraska Blue? Yeah, that My Blue.
Well, the other thing I'm thinking too is maybe they get you a list. Sometimes they give you a list of employees that they got the letter immediately.
I just think it'd be great if
We
they got a copy, like on a page, available on the website or in a PDF to the employer.
Just like their EOB
on My Blue. Just make it something where it's available, when they're in charge of it. Right. Go online. Therefore,
The folks that are on the webinar, please speak up so they can hear what you're asking.
What if they were available electronically somehow for the employer to get, sometimes employees lose their W-2s, that type of thing. At least they don't have to want the paper. I'm sure all the employers don't want the paper. But if they can electronically either request it or have access to it.
I'll keep some of this stuff.
If you, Tracy, are you going to capture some of those questions? Because as we go through the process internally at Blue Cross, those are things that we need to know about. We've been talking about some of the exact things you're talking about. So it's just trying to get them prioritized and into some of the projects that we're running on this.
Once again, thanks for being here. Please help me thank Tracy and her team for hosting these great events. Your UNICO Midlands folks will be around if you have individual questions. If you think of something after you leave here that you wanted to ask but didn't get around to, or a colleague brought up to you, please send us an email so we can follow up. And obviously, if your colleagues bring up questions you didn't think of, let us know. Thank you very much for being clients of UNICO Midlands. Thank you for being here. safe travels on the way.